Today, corrections, rates, steel and risk. The DFA daily to the 3rd of December 2021. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and prop news with a distinctively Australian flavour. In today's show, we discuss the likelihood of a real market correction. The signs are not good. Why monetary policy needs to be tightened. How China is cutting Australia's steel throat. And risks in the banking system. 4 big but actually connected themes. First, as Barron's wrote, to say that the Omicron variant is shaking the market would be an understatement. But add that stocks are more expensive than they've ever been, and a true correction now wouldn't surprise anybody. The S&P 500 fell about 4% from its all-time high in late November, just before scientists in South Africa reported their first COVID-19 new strain. And on Friday, the market had its worst day of the year. Then this week, Tuesday, was more ugliness, with producers of the vaccines and treatments predicting the remedies probably wouldn't be as effective against Omicron as other variants. And the pain continued on Wednesday, when the US confirmed its first Omicron case. In fact, US stocks snapped a 2-day skid on Thursday, with the Dow Jones Industrials producing the best percentage gain since early March as investors looked past the spread of coronavirus and a fuzzy path for monetary policy and indeed the US economy overall. Wall Street may be taking some solace from a report of a second case of the Omicron variant from a Minnesota resident visiting New York, which was reported by Minnesota public health authorities, but who showed just mild symptoms. The Dow Jones Industrial Average rose 1.8% to 34,639. That's the best percentage gain since March the 5th, 21, and the best point gain, actually, since the 9th of November 2020. The S&P 500 rose 1.4% to 4,577. That's its best day since October the 14th, and the Nasdaq Composite picked up a more modest 0.8% to reach 15,381. Now, there was an incredibly volatile session on Wednesday when the Dow dropped 1.3% and the Nasdaq slumped 1.8%. But on Thursday, stocks finished higher for the first time in 3 sessions, but with some bulls still saying the downtrend may feel longer amid a slide characterized at times by stomach-churning swings and white-knuckle climbs. There is huge volatility still out there. Investors have been on edge because the Omicron-inspired jitters have resulted in some erosion of upward trend lines for the main stock benchmarks, and bears wanted to see if another shoe would drop on Thursday to help solidify the downtrend. The bouncing in the markets due to incoming news has slowed, with markets led by cyclicals and the recovery trade, wrote Rob Hamworth, Senior Vice President and Senior Investment Strategist at US Bank Wealth Management. On Thursday, health officials confirmed another case, a Minnesota resident who had recently travelled to New York City for a convention experiencing mild symptoms and has since recovered. The new case makes it more likely that further infections from Omicron will occur in the New York area. The hope, though, is that Omicron is more benign than expected and any shutdowns will be limited in time and scope, UBS wrote. As expected, President Biden said that the US was ramping up COVID-19 testing for travellers entering the country and said he planned to extend a mask mandate on airplanes and other public transportation as part of a broad administration effort to combat new strains of coronavirus. Thursday's trading followed a very ugly Wednesday that was precipitated by confirmation of that first US Omicron variant case that sent the S&P 500 below its 50-day moving average for the first time since October the 13th. It seems that investors' main concerns remain the uncertainty around the Omicron coronavirus variant and the implications of any new restrictions that could hit the global economy, said the head of research at JFD Group. And it also came as Fed Chair Jerome Powell, for a second day, brought up the prospect of a quicker taper, which in turn sets the stage for more and faster interest rate hikes. In fact, on Thursday, Atlanta Fed President Raphael Bostic said that the central bank may have to taper bond buying programs sooner rather than later when speaking at a Reuters event. And meanwhile, San Francisco Fed President Mary Daly said she doesn't think the Fed needs to raise interest rates above the so-called neutral level, which is estimated around 2.5%. And in economic reports released on Thursday, the initial jobless claims climbed 28,000 to 222,000 during the Thanksgiving week. Meanwhile, the House was prepared to pass an extension of government funding through to February the 18th in a bid to avoid a partial shutdown this weekend, which some analysts said was adding some additional loft to equities. Ross Mayfield, investment strategist at Baird in Louisville, said that bullish investors shouldn't get too ahead of their skis. However, we think a lot of recent weaknesses was actually related to the Fed pivot, with Omicron just providing a more salient narrative for the sell-off, the Baird analyst wrote. Forward performance will hinge on whether the Fed gets even more aggressive or pumps the brakes after resetting market expectations for 2022, Mayfield said. But that true correction of 10% plus falls has been elusive, even during all of these months of the pandemic. And that itself is a bit astonishing, since corrections are often a normal part of a larger bull market. One indicator, though, forecasts a correction like a dark cloud usually brings rain. The total US equity market capitalization is about 215% of US gross domestic product. That's the highest level ever, according to global financial data. Such a large number isn't good. It's bad, often a sign that a correction is just around the corner. In 1929, market cap to GDP is an all-time high of about 100% just before the famous stock market crash later in that year. In 2000, another high at around 150 just before a bear market, a drop of at least 20% began. And in 2008, a multi-year high just ahead of the financial crisis. So the upshot is, maybe there's a correction, but then maybe not. It's all in the hands of investors. To be sure, stock valuations aren't known to be the best timing tool for investors deciding should they go and buy some more or sell some stock. Valuations can stay high for a very long period of time, especially, of course, with all that central bank printing. For most of the pandemic era, in fact, the market has been valued at its highest level relative to GDP ever, but high valuations do indicate that when and if the economic outlook really does deteriorate, stocks can fall really hard. There is certainly the potential for additional market drops and heightened volatility in coming weeks as a result of this variant, especially given all the uncertainty surrounding it, wrote Christina Hooper, Chief Global Market Strategist at Invesco. There is room for a decent correction. What the market needs now is a little hope that vaccines will be effective against the new variant. Otherwise, get ready for a correction. I think that sums it up pretty well. Now, in its latest economic outlook published on Wednesday, the OECD projected Australia's gross domestic product will grow 3.8% through to 2021 before building to 4.1% next year and 3% in 2023. The expectation, according to the OECD, is that the vaccinated population will return to work, the labour market recovery will drive household consumption, aided by the recent temporary increase in government support and the gradual decline of the household savings ratio. The full reopening of international borders is also seen to actually boost exports and support the labour market recovery as tourism resumes and more foreign workers are allowed to enter the country. The predictions mark a significant upgrade from the OECD's June report, which suggested Australia's economy would grow at around 3.4% through 2022. The economy is recovering as strict containment measures, first imposed in some states in mid-2021, have now been lifted, they said. A downturn in consumer demand and billions in government support payments contributed to Australia's household savings ratio escalating through the September quarter. The OECD believes that these cash reserves will boost the economy in the months to come. Given that most employment relationships were preserved during the recent lockdowns, a rapid unwinding of accumulated savings could drive a stronger rebound in activity in the coming months, the report said. The removal of border restrictions and the long-delayed return of working migrants and international students will boost the nation's tourism and education industries. Easing border projections are also slated to have a positive impact on Australia's exports, further boosting trade figures, even as lingering tensions with China, quote, represent a downside risk. Inflation is also expected to rise, particularly due to supply chain hold-ups, they said. However, wage pressures are expected to remain contained, squeezing the Reserve Bank of Australia's expectation for wages to rise 3% by 2023. The OECD believes the RBA may need to tighten monetary policy faster than it's currently anticipating. The RBA has been advised to exercise vigilance in respect to signs of rising inflation, with the OECD cautioning the country's central bank may need to tighten monetary policy faster than anticipated. The OECD urged Australia to focus policies on enabling resource reallocation. It noted that given some structural changes that have occurred during the pandemic, resource reallocation should be promoted, including through occupational licensing reforms and changes to land use regulations that could easily allow land to be repurposed. And it also judged that further fiscal support may be needed if the recovery falters, urging the government to lay out a clear medium-term fiscal strategy with well-defined targets and timeframes. Now is also an appropriate time for a review of Australia's monetary policy framework, the OECD said. Reiterating calls for a review of the RBA, the OECD referred to a prolonged episode of undershooting inflation targets, the new monetary policy tools that were deployed during the pandemic, and the changed environment for macroeconomic management. Now, of course, earlier this year, Treasurer Josh Frydenberg backed the OECD, noting he was open to a review, but one that would likely have to take place post the election. Or more recently, the RBA governor sort of said, well, you can review some of our use of policy tools, but that's about it. Actually, if you listen carefully to what the OECD is saying, they're basically playing it both ways. Sure, there might be some improvement, but there might also not be. Now, elsewhere, APRA is moving the prudential goalposts for banks, insurers, and superannuation trustees. They're looking to protect the financial sector against crises and shocks with new loss absorption requirements and proposed planning standards. APRA Deputy Chair John Lonsdale said that crisis preparedness sat at the very heart of APRA's purpose as a regulator within the financial services sector. Although Australia has one of the strongest and most stable financial systems in the world, and failures are extremely rare, businesses in any competitive market can face financial difficulties. Should that happen, we want to be sure each entity has the capacity to either recover or manage an orderly exit with the smallest possible impact on the community and the financial system. The first of the two new crisis preparedness measures that APRA is looking to introduce under CPS 190 will require all APRA-regulated banks, insurers and super funds to have plans detailing how they intend to respond to financial stresses. APRA-regulated entities have made substantial improvements in contingency planning over recent years. However, there remain large gaps in capabilities between entities and across industries, Lonsdale said. While small entities will be subject to some of these requirements, APRA said that adjustments and expectations will be made in accordance with the size, complexity and business model of the entity in question. And the second measure that APRA has proposed will require complex APRA-regulated entities to have preemptive actions designed to assist regulators in the event that they collapse. By laying out a consistent, transparent and enforceable framework, APRA will be better able to strengthen crisis preparedness and close those gaps, Lonsdale said. The regulator is now looking to enter industry consultation on those two measures, with a tentative enforcement date of 1st of January 2024 in mind. And also, APRA has moved to finalise new requirements for Australia's Big Four banks. They will require ANZ, CBA, Westpac and NAB to increase their loss-absorbing capacity from 3% of risk-weighted assets to 4.5%. Through these adjustments, APRA said it hopes to make the possibility of recapitalisation in a major bank via a large pool of private funds more feasible than doing so using public money. Crisis preparedness and resolution planning gets to the very heart of APRA's purpose to protect the financial interests of bank depositors, insurance policyholders and superannuation members, Lonsdale said. Now, just a quick observation here. They are, of course, quite worried about the risks in the financial system. They won't probably say it publicly. And so this is an attempt to try and further bolster the financial system here. But 2024 is a long, long way away, and we've got a very rocky road ahead, not least because of potential losses emanating from property price stabilisation or even falls ahead. So it's again too little, too late from the regulator. And finally, just recalling what the OECD said, that trade relations with China, which have already deteriorated, represents a downside risk, and China has already placed tariffs and restrictions on major Australian exports, and these could be expanded if the trade dispute worsens. So a very important piece from the AFR on steel. They said China will boost domestic iron ore production by 30%, significantly ramp up investments in overseas mines, and strengthen scrap steel recycling under a plan designed to break Beijing's dependency on Australia's most valuable commodity export. China's top steel industry executives and senior government officials outlined a strategy for achieving the 5-year target in an article published this week, which highlights the Chinese government's frustration with volatile iron ore prices and its desire to follow Japan's lead by investing heavily in offshore mines. The article, published in the state-backed Economic Daily, singled out Australia and Brazil for dominating China's imports of the steel-making ingredient. Control of overseas iron ore resources is obviously insufficient, and more than 80% of the import volume comes from Australia and Brazil. The risks to resource security are prominent, said Chen Qi, a senior executive at China International Engineering Consulting Corp., a major advisor to the Chinese government on investment and construction. The move came as tensions between Australia and China over Peter Dutton's warning about Taiwan escalated, with Beijing calling the defence minister delusional and warning Canberra it was going down the wrong path towards the point of no return. Speculation this week that China's steel mills were preparing for an easing of production cuts as soon as next month also sent iron ore prices surging. China's Ministry of Technology and Information Technology, the MIIT, first published details of a 5-year plan to slash iron ore imports in January this year, but there has been little reported discussion until now about how it would achieve the ambitious targets. Australian miners are sceptical about China's long-held ambition to increase domestic production, given its high production costs and lack of quality iron ore. China's own officials also admitted that there was a lack of untapped high-quality iron ore resources globally. Chen outlined a target to have mines with major Chinese equity stakes providing more than 20% of imported iron ore by 2025, compared with 8% currently. And the article notes that overseas mines, partially owned by Japanese interests, accounted for 60% of that country's imports. While the development of the Simandou iron ore deposit in the Western African country of Guinea has been seen as China's best bet to reduce its dependency on Australia, the project comes with huge risks. The threat of the Omicron variant in Africa now adds to that uncertainty, given the difficulties China already has sending workers overseas during the pandemic. It's also been exploring possible joint ventures with Russia, Myanmar, and Mongolia. Mr. Chen acknowledged the high risks in his comments and noted most of the world's high-quality iron ore resources had already been carved up by developed countries. Only low exploration levels, poor resource conditions, large investment scales, long return periods and backward infrastructure are left to Chinese enterprises, he said. The report also confirmed China's ambitious plan to increase domestic iron ore concentration production by 100 million tonnes per year to 370 million tonnes by the end of 2025. Officials said this could be achieved by accelerating output from 25 existing iron ore mines and developing 28 nationally planned mining areas. The Secretary-General of the China Metallurgical and Mining Enterprise Association said policy constraints and complex permit approval procedures were slowing construction of new large-scale mines. He said investment in China's domestic iron ore sector rose by 25% from January to September this year, but was still at historically low levels. Inspectors from China's state planner, the National Development and Reform Commission, the MDRC, were working with steel giant Boa Steel to coordinate more closely and remove policy obstacles into domestic iron ore development, it said. The third pillar of the iron ore supply plan is to increase scrap steel for recycling. The report quoted a top official from the Metallurgical Industry Planning and Research Institute who says the total supply of scrap steel resources could reach 340 million tonnes in 2025 from 230 million tonnes in 2020. That was higher than the 300 million tonnes target previously cited. The report adds new detail to a 5-year plan laid out by the MIIT earlier this year, which was first reported, by the way, by the Lowy Institute. That plan set a target of 45% iron ore self-sufficiency by 2025, which would be achieved by greater use of scrap metal, more efficient mines, and by investing Chinese equity into iron ore mining operations overseas. Hebei Province, an iron ore-rich area, approved 16 iron ore projects in November 2021, but most of them are environmental approvals relating to previously approved iron ore projects, not new initiatives. Commentators and investors said they remain sceptical about China's ability to cut its reliance on imported iron ore, but said the government was serious about winning itself off Australian iron ore at a time when relations between the two countries shows no sign of improving. They want control over the price, but they also are dealing with an unfriendly counterparty. If Australia was still friendly, they wouldn't need to do this. Nothing unifies the Chinese more than a common enemy, one investor said. The Chinese authorities have been frustrated for years by an inability to control wildly fluctuating iron ore prices, and the Chinese article noted the price of imported iron ore hit a record high of $233 per tonne in May, before falling 60% to about $90 per tonne. The vice chairman of the China Iron and Steel Association said the only way to tackle shortcomings facing the world's largest steel industry was by truly challenging the composition of iron ore resources. China's domestic iron ore output dropped 19% from 2010 to 2020. At the same time, imported iron ore hit a record high of 1.17 billion tonnes in 2020. While China has slapped restrictions or tariffs on $20 billion worth of Australian exports in the past year, iron ore remains safe from political coercion because China has been unable to source high-quality supplies elsewhere to fuel its huge steelmaking and construction sector. A report by the University of Technology in Sydney released this week said falling iron ore prices would make it difficult to mask the damage to Australia's trade with China. The Australia-China Relationship Institute report said from January to September 2021, the value of 12 disrupted goods fell by $12.6 billion compared with 2019. And at the same time, trade between China and the United States rose 33% to $603 billion. But the White House coordinator for the Indo-Pacific, Kurt Campbell, said on Wednesday that China's campaign for economic coercion against Australia had backfired and it would have to re-engage on Canberra's terms. China's foreign ministry said on Tuesday night that Mr. Dutton had made a delusional miscalculation on China's foreign policy. We urge certain Australian politicians to stop hyping up the China threat narrative for selfish political gain and stop going further down the wrong path towards the point of no return, a spokesman said. So there you have it. It is clear that the iron ore issue is far from over. And if the price continues to drift lower, or even go sideways, the economic impact on Australia is going to be significant. And so if you stand back and think about all the things we've discussed today, from market corrections, from the iron ore price, from the need to put more capital into the banking system, as well as the other dynamics that are going on at the moment, you can see that the markets are pretty worried. That's why I expect to see a lot more volatility ahead, and I still think there is a very significant risk of a market correction, but the longer-term risk, the real risk to Australian economics, is the fact that iron ore has been a champion provider of value to Australia for so long that we've become totally reliant on it. And if that does go away, or even reduce significantly, the economic chips are definitely on the table. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.